Noah Solomon, Chief Investment Officer at Outcome Metric Asset Management, sticking with us for a second block. It's great to have you here once again.
Thanks again.
Let's get to gold, because often portfolio managers will buy it because they think gold's going up. But you incorporate machine learning, AI, in your methods, and you say that actually gold, it's your program is throwing up gold for a different reason as an attractive asset. Why is that?
Yes, so our portfolio is currently quite overweight gold stocks, but to your point, most managers or investors would buy gold stocks because they have a bullish view on gold. That's not what we do. As you said, albeit steeped in investment theory, we do use artificial intelligence and machine learning and quantitative models to pick and weight stocks within our portfolio. They overweight gold stocks, not because I'm bullish on gold or the model's bullish on gold. It's because gold stocks as a group, you can find any individual stock at any given time, but as a group or as an asset class, gold stocks are the only group that have no correlation to stocks in general. So their diversification value is tremendous. So our quantitative models understand this lack of correlation mathematically, and they say this has tremendous value from a diversification perspective. Obviously, this has benefited the portfolio tremendously in this sell-off. As of last Friday, the portfolio was actually up on the year, despite most portfolios being down and every index being down.
I always tell guests, please don't be flexing too much.
I'm not.
I know people
flex.
can go to your website. Anyway, carry on, Noah. Yeah, please.
So it is favoring gold stocks, but for the diversification value, not because of a bullish view on gold per se.
That's interesting. Yeah. As an insurance policy, in some ways, you can say. Yeah. You do like the look of consumer staples, including the big food retailers in Canada.
Yes. So consumer staples have two qualities that our models like right now. One is that they tend to be very low volatility. They tend to be, for obvious reasons, much less volatile than other stocks. The other thing is these stocks tend to have a very strong track record of consistently raising their dividends. So I like to call them bonds in disguise, which are obviously a very good thing in this kind of investment environment.
It's interesting, yeah. Maybe we could put up Loblaws just for the sake of it. Loblaws lately has been hitting record highs. I don't think so over the past few sessions, but certainly it, like just about everything, is down from its highs. And then utilities, Hydro One and Fortis show up pretty well for you.
They also have similar qualities. They may not have the same diversification value as gold because they are correlated, but they are much less volatile. So like the grocery stocks, you kind of need your electricity and your power, and they do have steadily increasing dividends, and they are low volatility. So like the staple stocks or the grocery stocks, they are what I call bonds in disguise, which are particularly valuable in this kind of investment environment.
Are you, or is your model reluctant to buy stocks with no dividends? Is that
it will not do that.
Oh, that's interesting. It has to be a dividend.
Not only does there has to be a dividend, but you may not have cut your dividend at any point in the last 5 years, and you must have increased your dividend in at least 3 of the past 5 years.
So if people say, well, what about stock buybacks? Aren't they just as good? What would be your reaction?
Stock buybacks are not quite as good. It depends how they're financing it. The data on it doesn't go back quite as far, so we can't fit our algorithms the same way. So we just rely on dividends.
And I'm always curious. I mean, executives and boards think, well, the stock's undervalued, but you're not stock pickers. You're meant to be running the company. I'm always a bit wary of buybacks as well.
I hate to be cynical, but show me a CEO of any company at any given time that didn't tell people that their stock was undervalued.
That's right. It's a natural bias.
Yes.
Yeah. Leave us with a final thought. Are the markets going to end 2025 down? What is your gut feeling? I know that's a very broad question.
Well, I think to answer that question, you have to go to the main factors that will make the difference as to whether they're up or down this year. And going back to our earlier conversation, the main driver right now, the clear driver's seat, is the White House. It's the U.S. trade policy, escalation of trade fears. Unfortunately, you seem to have a very erratic policy environment where it can change from day to day. The comments can do a 180 from day to day. So you're in a very unique situation where it's based on something that really hasn't happened, in this magnitude, and which can change from day to day. So I'm happy to say I don't know when I don't know, but what I will say is that uncertainty is tremendously high. And when uncertainty is high, you generally are better off playing defense, especially because you're not really getting, stocks are not cheap. They are better in the rest of the world than they are in the US from a valuation perspective. Depending on where you are, Canada, Europe, Japan, they're more or less close to their averages, but nothing is screamingly cheap. So in an uncertain environment where nothing is screamingly cheap, it's generally better to play defense.
No, we'll have to leave it there. Thank you very much indeed.